Hello, today we are going to the other chapter, theory for investment portfolio formation. This is the third chapter for MSC students. So in this chapter, just this chapter has three objectives. When come to these chapters, at the end of this chapter, you should to able identifying of the theories for investment portfolio formation. So when come to the relationship between risk and return, the investors increase their required rate of returns as perceived the risk uncertainty increased. The line that reflects the combinations of the risk and return available on the alternative system, this is known as, or it is a so-called security market lines. This is the market, it shows that the line that the combinations of the risk and the returns available of among of different alternative investment. This line, it is a so-called security market lines. The investors would select investment that are consistent with their risk preference. Some would consider only low risk investments, whereas others welcome high risk investments. So this is the relationship between the risk and the returns. So the risk is uncertain outcomes. The return is the results of the investment amount. So this is simply it shows that the risk and the returns. So when comes it is a portfolio theory. What is a portfolio theory? The portfolio theory, it is one of the influential economics theory that deals with the finance and investment. So this theory is designed by Harry Marcus. This person born on August 24, 1927 and was published in 1952 in the Journal of Finance under the name of portfolio selections. So this theory, it's indicating that economics theory. Sometimes this one is economics theory because of influential part that it deals with the finance and the investment. So the final product of his theory, the capital asset pricing models, CAPM stands to, C is refers to capital, A is asset, P is pricing, M is model, which is still working for efficient investor to estimate the required rate of returns for any risky asset. The required rate of return means the minimum amounts of return from the givens of investment. The market pricing theory leads to mathematical explanations of the expressions. Don't put all your eggs in one basket. It is what? To minimizing of the risk. Risk ለመቀነስ ስንል ምንድነው ማቴማቲካል ኤክስፕሬሽናችን እዚህ ጋር የምናየው ምንድነው ሁሉንም እንቁላል በአንድ ቅርጫት አታስቀምጡ የሚል ህግ ነው ይዘው የተነሱት ማለት ነው እነዚህ ሰዎች which means በተለያየ ቅርጫት የምናስቀምጥ ከሆነ ግን ሪስካችንን የእንቁላሉን የመሰበር አቅም በተለያየ ዳይሬክሽንስ ላይ እንቀንሳለን ማለት ነው from to this the market pricing theory is lead to mathematical explanations of the expressions don't put all your eggs in one basket. We have the assumptions of market theory pricing models when come to years. The investors ask for maximizing the expected returns of their total waste. This way, investors maximize ያለባቸው ይላል ይሄኛው assumptions ላይ ስንመጣ when come to this point the investors maximize ማድረግ የሚጠበቅባቸው ምንድነው ማለት ነው ፕሮፊትን ሳይሆን ዌልዝን maximize ማድረግ መቻል አለባቸው ማለት ነው. So this is the concept of the corporate finance. The concept of the corporate finance, any firm, the objective of the firms in financial management, that are the so-called wealth maximizations. It's not the profit maximizations. So the investor asks for maximizing of their wealth. All investors have similar expected single period investment horizons. All investors are risk averse, not the risk takers. All investors are risk averse, not the risk taker, which means they only will accept a higher risk if they are what compensated with higher expected return. This theory shows that the expected return and risk have direct or positive effects. So the investor based their entire investment decisions on the expected return and risk. So the investor prefer high returns to lower returns for the given levels of risk. When come to years, in this point, when the investors are prefers to the higher return, they guess of what? High levels of risk. Whereas when the investors is prefer the low returns, that the levels of the risk should be what? Low. This is the assumptions. What are the risk attitude tendency of each? The Martha shows risk aversions because here certainty equivalent the expected value of the gambles. Ryan exhibits risk indifference because her certainty equivalence equal to the expected value of the gambles. Sarah reverses risk preference because her certainty equivalence exceeding to what? The expected value of the gambling. So this is the risk attitude tendencies for each of the authors. So in come to years, how to determining of the portfolio? The expected return. The expected return is equal to, this is the sum of the weighted average of times the average rate of returns. RP bar is refers to the expected return for the portfolio. W is standard the investment proportions for the given assets of the J's asset of the portfolio. R the red bar is the expected returns of the J's asset. M is the total number of assets in the portfolio. So what is the portfolio risk? Portfolio risk is associated with the collections of assets or securities. So this is the diversifications. In portfolio risk, we should do what generally this is a security by itself has more risk than when held a portfolio. Diversification is reduced variability of the returns. Reduce of what? The variability of returns. So በአንድ ቦታ ላይ ያሉንን ፖርትፎሊዮ አሰቶቻችንን በአንድ ቦታ ከማስቀመጥ ይልቅ ዳይቨርሲፋይ አድርገን የምናስቀምጥ ከሆነ የምናገኘውን ሪስክ ወይም ደግሞ ሪስካችንን ሚኒማይዝ ማድረግ እንችላለን ማለት ነው። ስለዚህ one of the techniques to minimizing of the risk is the so-called diversification. The diversification is shown that reduce variability of the returns. As the number of the stock increases in portfolio, the portfolio total risk decreases. It's known as the diversification effect. You see, the stock increases in the portfolio's total risk decreased because of what in diversifications. So when we applying of what in our stock in diversifications, we come to minimizing of what the risk. By the way, when come it is total risk is refers to that are the overall the risk in our company or in our stock. So total risk is decreases in during of diversifications. So we come to how to determining of the portfolio standard deviations. The standard deviation is determining by using of the square root of here the summations of J1 K1 times this is the weighted investment proportions of the J's asset multipliers of the weighted investments of the K's asset multipliers by the covariance between the returns for the J's and K's asset. So this formula it shows that how to determining of the portfolio standard deviations for in our company. That are the way it is to measure so this asset. What is a covariance? Covariance is to determine or compute by using of this mathematical expression. The covariance is the standard deviations of the J's asset and the K's asset multiplied by the correlations coefficient. The correlations between. So ለምሳሌ J እና K የተባሉ አሴቶች ቢኖሩን እነዚህ J's እና K ሁለት አሴት ቢኖሩን የዚህ ስታንዳርድ ዲቪዬሽንስ የሁለቱ አሴት ብዜት በኮሪሌሽናቸው ስናባዛ ምን ማግኘት እንችላለን ኮቫሪያንስን ዲተርማይንስ ማድረግ እንችላለን ማለት ነው ኮቫሪያንስ ዲተርማይንስ ማድረግ እንችላለን ለምሳሌ portfolio risk and expected returns when counting these points you are creating portfolio stock D and stock B you are investing $20,000 in the stock of BW $3,000 is in the stock D remember that the expected returns the standard deviations of the stock of BW is 9% and 30.5% respectively. The expected return in the standard deviations of stock D is 8, that one is 10.65% respectively. The correlation coefficient between BW and D is 0.75. What is the expected return and the standard deviations for this portfolio asset? The portfolio asset is the combination of all different assets. Here the portfolio assets, the first one is the stock D and the stock BW. We have two kinds of assets. What are the returns? ካምፓኒያችንስ እነዚህን አሴቶች ቢኖሩት ከነዚህ ኢንቨስትመንት ላይ ከተለያዩ አሴቶች ላይ የምናገኘው ኤክስፔክትድ ሪተርን እንዴት ነው የሚለውን ነገር እዚህ ጋር ማየት እንችላለን ማለት ነው ያው መጀመሪያ ምንድነው የምናደርገው ሰም እናደርጋለን ባርጉ እዚህ ጋር when count years ያው መጀመሪያ weight average እናገኛለን the weighted average of the first asset or the first stock is $2,000 this is a given this one is this asset also 3,000 we add them the total portfolio is what 5,000 when the add of these two assets we can get this value so this is 2,000 plus 3,000 is 5,000 what is the proportions what is the weighted average or what is the proportions of each portfolio assets for the total investment so 2,000 divided by 5,000 we can get 0.4 this asset also 3,000 divided by this one 0.6 asset we can get this ratio so the expected returns of the portfolio we can get by using of this one here the weighted average of BW the first asset or the first stock multiplies by the expected returns of BW returns plus the stock of D the weighted average of stock of D multiplies by the returns of D so we can get here this value is we can get from this one here 0.4 multiply this is the givens this one is already calculated 0.6 this is a givens so multiply this one ያንዳንዱን ስቶክ ላይ ያሉን አሴቶቻችንን weight average-አቸው በኤክስፔክትድ ሪተርን weight average በኤክስፔክትድ ሪተርን ካባዛን በኋላ ምን እናደርጋለን ደምረን እናስቀምጣለን ማለት ነው ስለዚህ the total expected returns or the portfolio expected returns of the company is 8.4% ነው ማለት ነው ስለዚህ ካምፓኒው ካጠቃላይ ካሉት አሴቶቹ ወይም ስቶክ ላይ ካሉ አሴት ኤክስፔክት የሚያደርገው ሪተርን 8.4% ይሆናል ማለት ነው so standard deviations to asset ላይ ስንመጣ standard deviationአችንን በዚህ አይነት ወይ ኮምፒውት ማድረግ እንችላለን we can't calculate we can't compute by using of this mathematical expression you see the standard deviations of the expected return is the square root of the weighted average of square of x this is the first asset or the first stock of this one the standard deviations of square this one is x the weighted average square times 1 this multiplies by this one we can get we have what two assets so this is plus multiplies by 2 when this asset is 3 we can to multiply by the 3 so this is we have two assets plus 2 times wx times wy it is a multiplication of what covariance of x and y recall that the covariance of ij equals to the correlations of rij times the standard deviations of this value covariance we can to determining by using of this one by using of these techniques we can to determining of the covariance so the standard deviations of the portfolio will be this is 10% this one is check by yourself because we have different formula in the above and we can to substitute, you can to substitute, and you can define the value. This is the exercise for you. This is exercise for you. Check the result. Efficient portfolio. The other theory that are the so-called efficient portfolio. A portfolio with the highest expected return for a given level of risk, or a portfolio with the lowest risk for the given expected return. So this is the efficient frontiers, the set of efficient portfolio management. We can to create in our company or in our organizations. We should to have applying of this efficient portfolio management. Look this one. Achievable to security portfolio efficiency, the four frontiers. This represents the set of the portfolio combinations that are achievable by varying relative wealth and using to non-correlated securities. To non-correlated security. This graph is, it shows that the standard deviations are here 0 from this value, and this one is the expected return. The expected return. It is to increasing of this increase. This graph is, it shows the increasing of this graph. The expected returns of the company is what? Increased. The expected return is decreased. This also the standard deviation, so that the company is decreased. This efficient frontiers. Look this one, investment choices. How to choice for different investment alternatives. The concept of dominance illustrators. Look this one. We have this one is the investment A. This one is the B investment. We have two investments A and B. So how to choose for the givens of this investment, for the givens of risk, for the givens of returns. A dominates to B because it offers the same return but for less risk. ሪተርናችንን ስናይ ተመሳሳይ ነው። ለምሳሌ ኤ ላይ ስትመጡ የምናገኘው 10 ነው። ቢ ላይም ስትመጡ ያለን ስንት ነው? 10% ነው ሪተርናችን። ኢንቨስት ከምናደርገው ላይ የምናገኘው ሪተርን አማውንታችን 10% ነው። ስለዚህ when come to this point, the risk levels of A's investment is 5%, B is what? 20%. According to, so we can to prefer so what? A, because the risk levels here decreased, we can get 5%, 10%. Here, when come it is the 10%, we can also, this value we can get. So according to, it's based on the lower level of risk, we can't what it is to decrease, or prefers this kinds of investment. Total risk is we can get the sum of the systematic risk plus unsystematic risk. Total risk የምንለው systematic risk ሲደመር unsystematic risk ነው. So what is the systematic risk? The systematic risk is the variability of the returns on the stock or the portfolio associated with changes in the returns on the market as a whole. So this kinds of risk, it is a so-called systematic risk. Unsystematic risk is the variability of the return on the stock or portfolios not explained by the general market movement. It is avoidable through diversifications. Look this one. Here this graph is unsystematic risk. This one is the systematic risk. When we get all this, the total risk is the sum of unsystematic and systematic risk. It is the sum both. We can get this is the total risk. This region is unsystematic risk. This one is unsystematic risk. So this is, we can add them. We can get the total risk of our company. Portfolio's total risk is firm's specific risk plus market risk, diversifiable risk plus non-diversifiable risk, non-systematic risk plus systematic risk. Consequently, the total risk of diversification portfolio is essentially equivalent to the systematic risk. There is a reward for bearing risk. We expect returns on a risky asset depends only on the asset systematic risk. Since unsystematic risk can be diversified way. The other one is beta coefficient. What is the importance of beta coefficients? What is the importance or what is the advantage of beta coefficient? The beta coefficient, when we to define the beta coefficient, is a relative measures of non-diversifiable risk. An index of the degree movements of an asset return is responsible to change in the market returns. ቤታ ኮኤፊሽንት ምንድነው? ሪስኩ ምንድነው? የምናገኘው ሪስክ ዳይቨርሲፋይብልስ መሆን ይችላል ወይስ አይችልም የሚለው ነገር የምናይበት ቴክኒክስ ነው ማለት ነው። The beta coefficient is refers to this asset is or this kinds of risk is it diversifiable or non diversifiable የሚለው ነገር ለማየት ቤታ ኮኤፊሽንት ይነካናል ማለት ነው። So this is the entire market. One, all other betas are used in the relation to this value. Look this one. An index systematic risk. It measures the sensitivity of the stock returns to change returns on the market of portfolio. So the beta for a portfolio is simply weighted average the individual stock betas in the portfolio. We can calculate by using of these techniques. Look this one. Beta coefficient is the covariance divided by variance. By using of these techniques, we can determine of this beta. After this beta, after this value, we can check whether in our risk is diversifiables or non-diversifiables. የሚለው ነገር ለማየት ይረዳናል ማለት ነው። So this is security market lines is the required rate of returns of the stock. RF is the risk of free rate of returns. BJ is the beta stock measures of systematic risk of that's one. So this is the expected returns of the market portfolio is M. So this is the required rate of returns we can calculate by using of this technique. You see RF plus the beta coefficients, this is average M of minus this one, we can get the security market source lines. That market line is this market line is it tells about whether our market lines is increased or decreasing functions. We can to check by using of these mathematical equations. We can to predicting of the security market lines of in our company or in our organization. Look this one. By using of these functions, you see, this is the risk-free returns. When come to this one is the required return. This is a systematic risk. So this is increased functions. You see, this one is the lines of this is the linears. This linears is indicating that what you call it. This market line is increasing functions. So we can by using of these techniques. So this is the maximum market lines 1. Okay, that's just one determination. So the required rate of returns. Lisa Miller's at Basket Wonders is attempting to determine the rate of return required by their stock investors. Lisa is using a 6% risk-free and the long-term market expected rate of return is 10%. A stock analysis following, the firm has calculating that the firm beta is 1.2. What is the required rate of returns of the stock of basket holders? You see, from this we have the formula, the previous formula. By using of this formula, we can to computing that value. So here we can check by using of this value. Here, these also are the givens. So the required rate of the returns of this value is 10.8%. 10.8%. So the market, the rate of the return is 10.8%. So this percent is exceeding to what? The beta coefficient. The market beta coefficient በላይ ነው ማለት ነው ይሄኛው. So this is also attempting of determine intrinsic value of the stock. He is using the constant growth models. By growth models, she was calculating of how to determining of the intrinsic value of the stock. By using of this technique, intrinsic value by using of this one. We can calculating of this value over this minus this one. We can get it. The stock is what? Overvalued as the market price. The market price was what? $50. Is that not? So this is the stock is what? Overvalued. Intrinsic value ከፍተኛ ነው ማለት ነው። Intrinsic value እንዴት ነው ከማርኬት ፕራይሳችን ይበልጣል ወይስ አይበልጥም የሚለውን ነገር እናያለን ማለት ነው። ስለዚህ ኢንትራንሲክ ቫልዩአችን እዚህ ጋር ምንድነው 10% ነው ያለው ግን ማርኬት ፕራይሱ ምንድነው ማለት ነው ከኢንትራንሲክ ቫልዩ በጣም ከፍተኛ ስለሆነ ይሄን ስቶክ ምን ብለን እንጠራለን ማለት ነው ኦቨርቫልዩድ ብለን እንጠራለን ግን ማርኬት ፕራይሳችን less than to what the market price is less than to the intrinsic value market price if the intrinsic value is 20 the market price is 15 so the market price is undervalues that's the intrinsic value from the intrinsic value the market price is less than so the stock is what we can say undervalued. The other model it is a so-called capital asset pricing models. The capital asset pricing models it is developed by John Linters and Jan Mossing simultaneously and independently in 1965 based on their earlier work of Harry Marcus. The Marcus and the Sharp received the Nobel Prize in Economics in 1990. Presents the multiple factors of the capital asset pricing model a much more restrictive theory. These models describe the relationship between risk and expected required returns. In this model, a security expected required return is the risk-free rate plus premium based on systematic risk of the security. So, there are different assumptions in capital asset pricing models. So, the first is capital markets are efficient. The capital market should be what? Efficient. It's not inefficient. The capital asset pricing models prefers to what? The investor expectations for a given period that should be homogeneous, not heterogeneous. Homogeneous means the same periods or the same levels. Homogeneous is refers to homogeneous investors' expectations. It is not heterogeneous investors. A risk-free asset return is certain use the short to intermediate term treasuries as a proxy. Market portfolio contains only systematic risk. It is only systematic risk. As I told you in the previous discussions, the market portfolio it is to consisting of what? The total risk. The total risk is two kinds of components. One of the systematic risk, the other one unsystematic risk. The capital asset pricing model assumption is included or you contains the systematic risk. An equilibrium's arbitrary pricing theory. This theory is also an equilibrium models of expectation return with multi-factors, firm size, book to market ratio, default risk. This one is also are the factors of what? The multi-factors of models. Three major assumptions here. The asset arbitrary pricing theory, capital markets are perfectly competitive. The investors always prefers more to less wealth. Pricing generation process is a key factors model. This is the very important assumptions in arbitrary pricing theory. So this was about chapter 3. Next time just we will continue the others chapters. Today is enough for us. Thank you for your attention.